Okay, hello everyone. Thanks for your patience for a 2-minute delay. Here we are. So I am Nathan Gendelman, President and Director of Investments here at the family firm, and joining me in the room are Stacey Backery and Steve Daly, two of our CFP financial advisors. So as we mentioned in the email, what we wanted to do is talk a little bit about what's been going on in 2019, maybe just a tiny bit of what's happened so far, but mostly just to think about where do we go from here, because that's always more interesting and really more relevant. So 2019, I would call it sort of a story of expectations rather than reality. So actual earnings have kind of been flat to down, yet the valuations in the market, which valuations to me are kind of synonymous with saying hopes and expectations, are way up. And it's always kind of interesting to think about, well, why? How has that happened? And what we decided for this call is rather than talk too much about what has happened, we'd rather just kind of think about tomorrow, and then actually sort of the answers are almost mirror images of each other anyway. So with thinking about what can happen, I guess the question we were asking is what if anything can reverse like the upsurge in optimism that's happened and cause a market decline? And how worried should we be about that? So what we ended up doing is coming up with 3 what we consider plausible, somewhat likely economic scenarios for 2019, and then tried to put them into a format that, at least for my mind, helped me conceptualize them a little bit better, which was to think about, again, just thinking about for 2019, how likely are they? How impactful would they be? And what, if any, strategies would one employ under either of those 3 scenarios? So the first one that I listed was, I guess I'm calling it anticipation of or even perceived inflation as a potential economic scenario. And sticking with the framework, just asking, well, how likely is that this year? And in our opinion, it's fairly likely that that will happen. How impactful would be? My sense is moderate, which I guess I'm calling similar to the end of 2018, which was certainly a pretty healthy decline in the market, but nothing that would really shake up someone's financial plan. Interest rates go up under this kind of scenario, stock valuations suffer. What would potential strategies be under this kind of scenario? And our take on that is that it would actually be kind of a rebalancing opportunity if they arose. Because really our core belief, based on just what's happening in the world, is that long-term inflation is unlikely, and therefore some sort of anticipated or perceived inflation is more of a transitory event, and actually kind of creates more of a rebalancing opportunity as people overlook what's really happening long-term in the economy. So that's the first, the anticipation of inflation. The second scenario, we would just call actual inflation, caused by maybe rising wages, or who knows, something else. How likely is actual inflation during 2019? Unlikely, it says here. How impactful would inflation be should it materialize? Very impactful, actually, because we have high and rising interest rates all over the place, short-term rates, long-term rates, mortgage rates. Would not be a pleasant situation for investors. What strategies could someone employ under a high inflation scenario? Emphasize to a large extent inflation-sensitive investments such as TIPS, the Treasury Inflation-Protected Securities, natural resources maybe, perhaps even such things as CDs and investments such as those. Now, with the investment approach that the family firm takes, those sorts of investments are almost always present in everyone's portfolio, but an onset of true and persistent inflation would probably necessitate increased allocations to those asset classes. So to summarize the inflation scenario, relatively unlikely for 2019, but highly impactful. In scenario 3, and I think everyone knows me well enough to trust me, but I did not just come up with this over the past few days. This was a scenario that even we knew about last week. It is just a breakdown in the trading system globally, with Exhibit A being our relationship with China. So the first question, how likely is that this year? And certainly as compared to if we'd been talking a week ago, we'd say that the chances of this are much higher than certainly had been perceived throughout the year, and that's really just leading up to last weekend. The impact, and I just apologize for this, but actually the impact is very unpredictable. And why am I saying that? It's just very hard to get a good grasp on it, because a truly strategic situation, which is really how to manage the rise of China into the existing geopolitical system, is all being managed as if it was nothing but a trading relationship. So trade is bearing the full brunt of the international rivalry, and that makes it really hard to predict, because it just ebbs and flows, and a very mercurial kind of situation that we're in. One thing to note is really the U.S. is not as heavily exposed to trade as perhaps commonly perceived. Certainly some companies like Boeing, Apple, Ford, our agricultural sector, and some others would feel an impact. But it certainly seems the American economy is well able to ride out a trade war that we've been in so far, and perhaps even what seems to be about to occur. Whereas it's the foreign countries who seem to suffer more so far. Adding to the unpredictability is, I just call it the Trump factor, and just the unceasing mayhem, uncertainty, bordering on chaos that revolves around so many important issues. So that really makes it extremely difficult to strategize something, because again, when you don't know what the range of possibilities are, it's hard to get in position for something. The scariest thing about a real breakdown in globalization and trade from an economic point of view is it actually increases the likelihood of inflation and recession. So again, two kind of contrary economic events. So again, hard to strategize. Hard to find too many bright spots under scenario 3. Perhaps one after things settle down would be that it could almost enhance the effectiveness of international diversification if the economic regions diverge a little bit more. By that I mean just an unwinding of globalization. Certainly people who've been investing globally over the past 10 years have not gotten much of a great diversification benefit from international investments, because they've, for the most part, been tracking along with the United States and doing a little bit worse most of the time. So not a lot of zigzagging or investments moving in different directions between Europe and the US and emerging markets. So not too many positives about a kind of a breakdown in trade and friendly relations between trading nations, but that could be one of them, is that the fates of the different regions throughout the world would diverge, and that gives diversification more of an opportunity to reduce risks. And naturally, these aren't the only 3 scenarios that could happen in the world or that the stock market would care about. And I've listed out a few others, but I guess just for right now, I'd love to hear other people's thoughts on it too. But to me, these just seem either too unlikely or just too speculative to worry about too much in May of 2019. And probably everybody has a favorite one, but we could throw in there, well, the rise in populism, corporation bashing, should concerns about the US debt ever arise, possibility of armed conflict in the Middle East or elsewhere. And even a recession, to us, doesn't really seem very likely or too much to concern ourselves right now, unless, again, there was a really extreme trade breakdown that could produce that. And that would require really something much more than the China tussle that's going on. So at this point, I just love to, take a breath and hear from you all what's on your mind and what kind of questions or thoughts that you have about what's been going on over the past week or really throughout the year so far. And everyone is unmuted now, so we're happy to hear whoever would like to jump in.
Hi, this is David Bund.
Hi, Dave.
I was wondering what you think about the inverted yield curve. I mean, I've been reading something about that, and a lot of economists being worried that that's a harbinger of recession, and just what your thoughts are.
Yeah, fascinating question. Thanks. And it's wow. It seemed like every day for about a month there, they were saying, "Oh, the curve is getting closer to being inverted. Look out!" And then, it happened, and then 3 days later, it unhappened again. And then they started to say, "Well, it only becomes important if it lasts for a long time." So I'm not really sure what to make of it. It's always kind of, I mean, a little bit scary when you just look at a graph and say it's going to predict what's going to happen. I think, really kind of a common sense way of thinking about it is that if the curve is inverted, that the interest rates for short term are higher than long term, which doesn't seem to make much sense. And that's why it seems to indicate something's wrong with the economy. But it usually kind of means that the Federal Reserve has screwed up, just to, state it in crude terms, that they've raised the interest rates much more than what they should be, because the long-term rates are really just controlled by the market, who are smarter than the Federal Reserve. And so it's usually just kind of the market's way of telling the Federal Reserve that you're tightening up too much. You're making lending too restrictive, and we're going to have problems if this continues. So, that probably makes a lot of sense, that would be a really bad harbinger of things to come. I think in this case, or really what we've seen over the past 6 months, I'll say, is that the Federal Reserve pays a lot of attention to what the market tells them, whether it's the stock market or the bond market. And kind of towards right around the middle or end of December last year, they kind of said, without really saying it so directly, that, oh, we get it. Like, we need to stop raising interest rates because there isn't inflation, despite the unemployment rate being so low and everything else going on. We hear you. We are not going to raise interest rates until the data tells us to, which is a pretty flexible term. I guess most people are interpreting that as basically throughout 2019, they figure they've done enough. Inflation is not even 2%. Things are going great. There's no reason to keep tightening the lending and hurting the stock market and causing the inverted yield curve. And basically, since they said that, the curve has gone at least slightly tilted upwards, with maybe long-term rates at 2.5% and the short-term ones 2%. So it seems like things are at least tilted back up in a northeast direction, which is supposedly okay. And I guess we'll just find out as things unfold if they should have kept raising rates or, what the situation is. But definitely, even on, what our belief is and what seems to really be true in the market is that they were fighting an inflation threat that doesn't seem to exist, to be honest.
Okay, thanks.
Thanks. Okay, well, if it's okay with you, we got a great question from Donna. Stacy, did you have that?
Yes, I do. She was basically asking if there's a major market drop, what plan could be made to protect current monies? Should something be sold in order to hoard cash to use in a lower market?
Yep, that's a great question. And actually I think it really just it almost seems like it's part of the human instinct. When things start to go wrong, we want to retreat and protect what we have, and that makes a lot of sense. Our kind of approach is a little bit different, that we try to actually put the things in place beforehand that can respond should the stock market go down. And again, I know Donna for sure has heard the word diversification a lot of times in her life, but that's really what it means, is that to have the things in place before there's a big drop in the market, so that there is a sufficient core of wealth that's protected, and then that provides the basis to buy back in, should it make sense, or to fund our living expenses, or, just to help us, go to sleep at night without the need of a lot of Ambien or something like that. But that's kind of what our thinking is, especially, a lot of our clients are at the point where they're retired or thinking about retiring, and they don't want to be, living off of what happens with the stock market on a day-by-day basis, for sure. So rather than wait until something happens and then try to react to it, our approach is, well, let's make sure that things are in place right now, and, hope that something bad doesn't happen. But if it does, well, we know we don't have to react in a panic mode. And it even goes to another, because one of the things I was talking about was scenario number 2 with the high inflation. And I mentioned that, we always have these things like inflation protected bonds or energy investments or commercial real estate. And, let's face it, over the past few years with inflation so dormant, those investments have lagged behind other ones. And, I'm thrilled that that's how things worked out, that the economic environment is so benign. But should that scenario emerge out of nowhere, which it seems like it always does when it happens, we'll feel better knowing that, we already have some things that are responding to the new world in real time, rather than having to try to chase everybody into those investment groups. Anyone on the line have any further questions or ideas, thoughts?
Well, I was wondering, this is David Bunn again, I'm sorry, but I was wondering about foreign bonds. It seems like they pay quite a bit more, and I know, there's more risk, but I'm wondering, the percentage that foreign bonds might play in a diversified portfolio.
Yeah, that's a great question. And some bonds do have a high yield, but other foreign bonds are very low. So unfortunately, it kind of works the way we think it would, where what are perceived as the safer countries, like Japan or Western Europe, their rates are really low. They're even below the American rates. And the rates in some of the, for lack of a better term, emerging markets, and I won't even talk about like Turkey or Argentina, but even some more economically stable places like Mexico or things like that, where the yields seem, they seem attractive, even in the 5 to 6% range. That doesn't sound so bad, but you do take on quite a bit of risk with those. And I guess our general approach to the international, and thinking about, emerging market international bonds, is quite frankly just to avoid them, because you can pick up a lot of reward along with the risk just by buying the emerging market stocks instead of the bonds, which aren't at least tied in with the chance of the government going bankrupt or having to go to the IMF, which happens much too often. So
Right.
in terms of the emerging markets, it always seemed to us that with the bonds, the risk reward trade-off isn't very good. But at least with the stocks, at least you're getting paid back for the risk, which is definitely there for sure when you buy, companies in Brazil or South Africa or something like that. It's risky, but at least over the long run, you get paid off for the risk. Where with bonds, that moderate rate of return isn't quite enough, it seems to us, to compensate for it.
Okay, thanks.
Thanks.
Hey, Nate, it's Mark Testoni. I'm driving, so I may be a little bit noisy here. Really quickly, given what you've discussed this evening and some of the perception in the stock market, have you made any, just in general, allocation changes already in anticipation of that, just to our accounts, or are we kind of just staying the course where we are right now?
Well, thank you, Mark. I feel safe in saying this across the board that over the course of 2019, if I've been erring, it's been on the side of conservatism. And as the markets rose in January and February and March and April, as I kept reviewing people's portfolios, for the most part, it was just to make sure that they had not become overexposed to stocks, and if so, to trim some back. And so that's, that if I'd sold something in January, looking at it in February, it didn't appear very smart. But now, as we've just seen over the last week, they do, things do go down too. But certainly over what we've seen over these past few days, I wouldn't say that there's any kind of buying opportunity or anything like that. I know you weren't implying that, but just for the, for the market to be down a couple of percent is not really anything that, we want to necessarily do anything with. But for sure, especially whether it was the end of last year where things had gone down by so much, or through the first 3.5, 4 months of this year where they'd risen by so much, that has created what what we just euphemistically call rebalancing opportunities. And, just trying to make sure that we bank some of the gains that have occurred in the past few months. Because especially, Mark, you were probably on in the beginning, but as I said, really much of the gains have just been from valuation increases and not really from profits on the ground, if you know what I mean.
I guess I'd ask a quick follow-on, given some of the other things that you talked about earlier. We've been in kind of a low interest rate era for 11 years now, I guess. And
yeah.
Do we think there's structurally, just given kind of the globalization and other factors, that maybe we're in for a longer term view of where really interest rates are renormalizing at lower levels? Or because ultimately that will, if they stay down here, probably keep the stock market a little bit afloat, just because where's the money going for return? Or do we think that we could really get into, I know you talked about your 3 scenarios, but even if we had inflation, makes you wonder how much you would really have. So at any rate, something along those lines, if you've got any thoughts on that.
Yeah, it seems like they're going to be lower for a lot longer than everyone had anticipated. Certainly the Federal Reserve, if you'd asked them a couple of years ago, they thought, by the end of 2020, we're going to be at around 4% or so. And it's probably pretty likely that they'll be around 2%. And it's just, again, I guess the causes throughout society are so varying. What do you call it? Not industrialization, but the ability of corporations to manage their costs, really, to replace expensive human inputs with machines, or the fact that, the age of unionization is long gone, the fact that, you know, many aspects of government and things like that are kind of controlled pretty strongly through corporations and things like that. But for anyone or some combination or maybe reasons that I'm not thinking of, the need for high interest rates to bring down or control inflation isn't really there. So I guess even another aspect, and Steve and I were just chatting about that briefly today, would just be even with you know, the lack of population growth in many countries, just the natural aging of society seems to have slowed things down quite a bit. Certainly you can see that in Japan, some other countries that are aging incredibly rapidly, like Italy. So again, I guess anything is possible. We'll both be alive. Actually, all of us here will be alive for a very long time, and things will change at some point. But really, it's hard to imagine a scenario where we need really high interest rates. And, you know, if interest rates can stay low, of course, that's supportive of the stock market in general. And we've seen that. I guess at some point it does exhaust itself. And, you know, at some point there's just no more money left to invest. One thing that it does sort of imply, and I guess this is for better or worse, that lots of, they're not fly-by-night companies, but kind of companies that maybe would have a hard time getting financing if interest rates were a little bit higher, like Tesla or Lyft or, you know, Snapchat, things like that, then maybe would have had a harder time raising so much money if the interest rates were higher, that those are really able to pretty much enjoy free money, whether it's, you know, in some cases to borrow. Tesla was just able to borrow a ton of money, which is kind of amazing when you think about it, at these low rates. And that's, you know, it's kind of, I guess it's kind of good and exciting for capitalism, because it's certainly, if you're an entrepreneur with an idea, you can find a lot of money out there. And I guess we'll just have to be, not we, but, you know, the world will have to be careful that we don't turn it back into a scenario like 1999, where just absolutely absurd companies were able to get financing from stocks and or bonds that were just, you know, just fantasies, had no business model at all. Certainly not the case for the companies I mentioned, but when there's so much money sloshing around and so much money can be borrowed so easily, it definitely can create some a risky situation. And of course, just a super quick follow up on that. Just, you know, we talk about our own interest rates of this I just call it ridiculously low rate of 2% in the long term context. And then we compare that with Europe, where it's negative, Japan, where it's negative. So savers there actually have to pay the bank or the government to hold their money. So talk about an environment that would encourage speculation, if anyone had any ideas there. For the Japanese version of Lyft, there'd probably be some people anxious to lend money.
On that note, this is David again, barging in. I've been reading that rents have been going up faster than housing in the States, and are there any investments in rental residential properties that you could invest in, because you can get loans so cheap, you know, and with the rents going up, it seems like you might be able to make some money. Thanks.
Yeah. Yeah, I suppose it's always hard for, you know, for an individual, but just because even with rental properties, everything is always so local. You know, definitely some of the REITs that everyone is invested in, they're quite a substantial fraction of them they do just own apartment buildings, and they've been able to, you know, reap the benefits, as you're saying, as really home ownership has gone down and demand for rentals has gone up. It always kind of depends a little bit on the city and how things are going and all of that, but yeah, rental units have been a pretty good investment for the, you know, these recent years on a macro scale. And we'll just have to see if houses become more or less affordable, or if there's been some sort of permanent shift in how millennials or just people in general think about home ownership, just as they're kind of rethinking about car ownership and some other things where people are becoming maybe a little bit more valuing flexibility and not attaching as much importance to the permanence of a home, and that's kind of helped an increase in demand for rentals. I'm not quite sure if that's a permanent trend yet, or if it's just something that we're still having the fallout from 2008.
Okay. Are there any funds that invest in things like that, or that we're in, or?
Oh yeah, certainly. If you looked in like a typical REIT index fund, it would show some of the companies, Avalon Bay Communities, I think, and a few others that just basically they own apartment buildings. And
Okay.
I'm sure everyone on the call knows how an REIT works. The tenants pay the rent, and it basically is passed out to the share owners.
Okay. Thanks.
Sure. All right, everyone. Well, thank you. And what we will do, as has become our custom, is to put the recording of the call up on the website, send out a link. We're always here if anyone has any follow-up questions or thoughts. But until then, I just really want to thank everyone so much. And as usual, the questions prompted, a discussion at least as interesting, if not way more so than what I prepared. So I really thank everyone for that. And so I hope everyone has a great evening, and we will speak with you soon. Thank you.
Thanks, Nate.
Thanks, Nate.
Good night.
Night.